What's going on, my fellow wealth creators? Matty Ice here. Welcome to another training. Today, I want to do a response video to an article that I saw from another video talking about the infinite banking concept. There's a lot of misunderstanding in it, a lot of misconceptions, and just not the best information. And it's like what I'm finding is a lot of the times when people are trying to bash the infinite banking concept, dividend paying whole life insurance, they're often telling only part of the story when they're picking it apart. And I appreciate that people do that. I did it too. You know, I try to pick apart really anything that I'm considering putting my money into. You should absolutely pick it apart, do your research, etc. But we want to make sure that we're providing accurate information and telling the whole story. So I want to go through the article. So this video might be a little bit longer, so I might break it up into a couple of different videos. So, but I do want to give a shout out really quick. Let me share my screen. I found out about this article from an interview that was done by Hazeltine LLC. I definitely recommend checking them out. They have some really good content. So shout out to Hazeltine. He did an interview video with Chris Kirkpatrick from Life 180, who's a big proponent of infinite banking and dividend paying whole life insurance, that kind of stuff. I'm also part of his team as well. But I want to go through this article because it has some really, really interesting stuff. So I'm just gonna start reading, and we're gonna address some of the main issues that the wealthy accountant has with infinite banking. See if he's right, see if it makes sense, and then go from there. All right. So when people have infinite banking explained to them for the first time, it seems like a magical, risk-free way to grow wealth. So the infinite banking concept is a strategy. The vehicle that we use for it is custom-designed dividend-paying whole life insurance policies with a mutually owned life insurance company. Okay, and the risk-free part is the actual vehicle itself. The dividend paying whole life insurance. I mean, anything can happen, I guess. And you have to be really irresponsible with a whole life insurance policy in order for it to blow up in your face and lapse. But dividend paying whole life insurance, it's going to be as close to a risk-free asset as you could possibly ask for. But the infinite banking concept itself is not magical risk-free way to grow wealth. It is a more efficient way to grow wealth, but depending on what you invest your money into when you take those policy loans, when you take the loan against your policy, that obviously has risk. So when I borrow against my policy to invest in do private money lending or flipping equipment and stuff like that, there's risk involved with that. So I wouldn't say it's risk-free, and if it's presented that way, it definitely shouldn't be. The idea of replacing the hated bank with borrowing from yourself makes so much more sense. A lot of the times it does. I still think the bank serves a purpose even when you are implementing the infinite banking concept. So I don't think it completely replaces banks, but it absolutely helps you take back a lot of the banking functions in your life, makes everything so much more efficient within your finances. But it does require replacing the hated bank for the hated insurance company. There is, a lot of hatred sometimes for insurance companies. I can understand that. The good thing though is, these companies, like these mutually owned life insurance companies, there's a big difference between mutually owned and stock owned life insurance companies, guys. And these mutually owned ones, really, really solid companies. They're some of the best companies you could ask to be partnered up with, which is what you own a part of that mutually owned life insurance company when you get these policies. Usually the biggest adherents of infinite banking are those getting paid to be a big fan. It's funny to me when people throw out this idea like it's bad to get paid for your products and services. Like this just doesn't make sense. I wonder what the wealthy accountant sells and makes money on. Like I don't really like this statement. It makes it sound like the only reason we do these policies or sell policies and help people set them up is to make money. Sure, if I help you set up a policy, I'm going to get a commission on it. But my commission is significantly reduced by the way that we design the policy. So it's not just about getting paid. And like getting these gigantic commissions, but you should want people to make money. As long as we're selling a product and service that is really providing value to people, I want everybody to make money, and I hope you're okay with me making money. So I don't like statements like that. Of course, insurance companies and their agents love the concept. They invented the sales pitch to sell more life insurance. No, Nelson Nash did. I mean, that's the story that I know. Anyways, Nelson Nash was the one that came up with the infinite banking concept, not a life insurance company. But does the sales pitch live up to real world experience? And actually, I would say too, to push back on this, there's some companies that actually push back against the infinite banking concept. They're not a fan. If you look at, I won't name like specific companies because things change all the time, but there's some companies that don't look too kindly to the infinite banking concept. They'll still set policies up to be used for the infinite banking concept, but they don't want it promoted that way. So just a little bit of pushback there. In this article, we will do first do the math. Bank yourself philosophy. Because fans of infinite banking might claim I'm being biased, I will use screenshots from a proponent's video and link the entire video at the end of this article. That he has screenshots of Chris Kirkpatrick's video talking about, I believe it was the infinite banking concept. Once I expose the fatal flaws within the infinite banking concept, I will share a strategy that actually delivers on the promise of infinite banking without the need of a bank or insurance company. I'm actually curious to learn what that is. There are no products to buy, and I will sell you nothing. You keep all the money. Again, there's nothing wrong with selling stuff. Not to mention, like, you don't pay the agents anything. The agents get paid by the life insurance company. So, if it all comes down to value. It's not wrong to buy stuff. It's not wrong to sell stuff. Like, we buy products and services to add more value to our lives. So, and solve problems. That's absolutely what the infinite banking concept can do. It solves a lot of financial problems in our lives. There are two serious financial disasters built into the infinite banking concept. I'm really curious to see what those are because I have not been able to find any disasters so far. It's a really powerful strategy. I'll expose these flaws as we work through the math of how infinite banking really works and how you can do much better. Cool. All right. Infinite banking is a twist on the sinking fund. I've actually never heard of that before. Just looking at the screenshots that he took and when I was listening to the interview done with Chris Kirkpatrick and Hazeltine LLC, I understand what he's talking about, but I've actually never even heard that term. A sinking fund, in a sinking fund, money is saved to fund the purchase of a big ticket item, say a vehicle. And let's see. Yeah, right here. So this is the screenshot that he has. So basically what you do is we save money. This, let's just say like each one of these steps is a year. All right. We save money for the year. All right. Or right here. So we start here. We save more money throughout the year. Now we're here, save. And then when we have enough money to purchase, in this case, the vehicle, that money just disappears. It's gone. And we start back at zero right here. And then we repeat the process over and over again. Boom, 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 boom. We keep repeating. And I've done a video on this, guys, why purchasing a vehicle with a dividend-paying whole life insurance policy, the infinite banking concept, is a far superior way and the most efficient way to purchase a vehicle. I've done multiple videos on that. I will link them down below. I highly, highly, highly encourage you to check them out because these things make those types of purchases so much more efficient. It helps eliminate lost opportunity cost. And I go into a lot more detail on that. So, but that's basically what's happening is we're saving a bunch of money, we spend it on the vehicle, and then we deplete that account, and that money is no longer earning interest for us anymore. That's basically the idea here. Okay, so infinite banking swaps out the bank deposit with the insurance company. So instead of saving money, putting money into a savings account at the bank, you're making premium payments to the life insurance company for your policy. And uses a good story to convince you the insurance company has a better deal. They absolutely do. Plus, you get life insurance. All that's true. So, instead of having my money sitting in a checking or savings account, not really doing anything for me, I can put it into a life insurance policy that's going to net 3 to 5% tax-free compound growth for life. Plus, I have the life insurance death benefit in case something happens to me. It acts as an emergency and opportunity fund. It gives me so many more benefits than just sitting in the bank. And then when I borrow against the policy to purchase the vehicle, which I actually did, that I paid $28,000 for my car cash, but I didn't take the cash from my bank account and give the cash to the dealership. I first put that cash in a dividend-paying whole life insurance policy. That money is going to continue to get that 3 to 5% uninterrupted tax-free compound growth while I purchase the vehicle. And yeah, there's an interest cost to that, but it's a small price to pay to get that uninterrupted tax-free compound growth. Not to mention, my interest rate is really good compared to what a lot of other people have right now. My interest rate on my policy loan is 5.5%. And I know people paying 8, 10, 12% on cars right now because interest rates are high. So yeah, just keep that in mind. All right. Except that is not exactly true. The insurance company can no more give you a free ride than a perpetual motion machine gives free energy. Nothing works that way. That just seems pretty useless, but okay. Because my bias is against infinite banking, I will use screenshots. Okay. All right. The promise of infinite banking is that a properly structured whole life insurance policy provides a safe place to save money so you can borrow from yourself. You're borrowing from the life insurance company, not yourself. Your cash value is the equity that you're borrowing against. At a future date to invest in income producing assets. That's actually a really good definition of, or like for the promise of infinite banking. That's actually really good. All of that is true. We custom design these policies. I've done tons of videos on my policies, guys. I have 2 of them, and I break down how I structure them. Because there's a very particular way you want to design the policy based on what you're looking to accomplish. But typically, if you're trying to implement the infinite banking concept, we want to make sure we design it for high cash value so we can start using that money to produce things like income producing assets and take advantage of wealth building opportunities. So it's absolutely a safe place to save money too, because I mean, guys, when you do your research on this, and again, I've done videos on this comparing banks to mutually owned life insurance companies. When you look at history, these mutually owned life insurance companies are a far safer place to store large amounts of wealth and capital, where, if we're saving for emergencies and opportunities, and we're eventually going to use that money for either one of those things, why not have that money in the safest place possible, in the most efficient way possible? When you look at the history of banks, it's not good. They don't have a good track record of safety. Banks fail all the time. While the banks have failed throughout history, mutually owned life insurance companies pay dividends to their policyholders. So it's just something to think about. If the whole life insurance policy is structured properly, placed with an insurance company that pays interest even on funds you have borrowed out, yes, that's true. Because again, we're borrowing the life insurance company's money. We're not using our own money. And that's why our cash value is able to get that continued uninterrupted compound growth. You can double dip by borrowing from yourself, from the life insurance company, to buy income producing assets, while at the same time earning interest on the full value of the account in the whole life policy. Very well said. That is correct. This, in theory, supercharges your ability to grow wealth. It absolutely does. I've done videos on how I just closed out one of my first investments using my policy. I break down all the numbers. Pretty crazy return. And it really does help you accelerate the wealth building process 100%. Now let's see where it all goes wrong, and usually leads to financial collapse. It doesn't, unless you're really irresponsible with your policy. And really where it can collapse is if you don't manage your policy loans. Like if you max out the policy loan from your cash, like you max out all your cash value in the form of a policy loan, and you don't manage that and pay that back, that simple interest, which is what we pay, the interest on the policy loan, it's simple interest, it can compound against you if you don't pay it. So yeah, you can get into trouble that way, but that's really the biggest risk when it comes to the policy. Above screenshot of the Life 180 video. Yep. So he's talking about the sinking fund there. In a sinking fund, you save money to handle large future purchases. For example, you may save a monthly amount in a sinking fund to replace your car, and then you buy that car with cash. That's typically what people do. But when you discover infinite banking, you realize there's a much more efficient way to do that. The problem with this sinking fund is that when you spend that money on the vehicle, that money is never able to earn interest for you ever again. And I go through this in the video, but I just want to show this to you guys. I really want this to hit home, because like this is the kind of stuff that like these really big light bulb moments for me, where like everything I had been taught about money just kind of went out the window when I started seeing the actual numbers of how these things work. And infinite banking just became an absolute no-brainer for me. It just made so much sense. So if I take, I paid $28,000 for my car. All right, let's do this over 40 years. So I'm 35 right now. Let's say I go to 75 and I'm ready to retire. Okay. So estimated interest rate, I usually do 4 because these policies typically net between 3 to 5%. Over the life of the policy. All right. Watch how much this actually cost me, guys. So when we look at this, when we look at what the interest, the opportunity cost here, the interest I'm no longer able to earn by utilizing the sinking fund strategy there, where I'm saving up the $28,000, and when I have it, I spend it, I deplete the account, the money's gone forever, and no longer able to earn any interest for me. it actually cost me $134,000 over 40 years for that vehicle. That's lost opportunity cost, guys. And when you think about how many large capital purchases we make throughout our lifetime, these numbers can get staggering. So by using my policy, I was able to put all this money, I recaptured that lost opportunity cost in my life. Okay, where I'm not losing out on $134,000 of interest or eventually what the value of that money would be. This guys, this really adds up. Not to mention all the other benefits that come with buying a vehicle with your policy, which I talk about in other videos, because you're in control of how that loan gets paid back. Nobody can come and repossess your vehicle. Like, there's so many more benefits. So the argument made in the Life 180 video is that you never get anywhere with a sinking fund. I mean, that's not, I would disagree with that. I mean, I think with a sinking fund, it is better than financing it through a bank. A lot of the times it depends. If you could take, in my example, the $28,000, and let's say I could get a car loan for 4%, or 3%, whatever. Like, my credit's really good, interest rates are at 0 again. If I could get a 3% car loan, then I could take that $28,000 and make 6% or 10% or whatever, doing implementing my wealth building strategies. Then it makes sense to finance with the bank. But a lot of the times for your average person, paying cash is better, because it just, like, why would you pay more for the vehicle with interest and stuff versus paying with cash and not having that debt? So I would say there's some instances where it does make more sense doing it with sinking fund. Sometimes it makes more sense with financing, etc. You deplete the fund when you pay cash for the car and replenish the sinking fund only to the previous level. That is a massive misunderstanding of the sinking fund. I don't a massive misunderstanding. No, I think he was just talking about like specific examples of saving to when you reach the amount of money in the account that you need for that large capital purchase. But I think the misunderstanding here is that maybe, like, once you reach that amount, you stop saving. No, you always want to be saving money, in my opinion, anyways. So I wouldn't call that a massive misunderstanding. But the money in a sinking fund earns interest. Okay, but like, historically speaking, guys, what have checking and savings accounts paid in interest? Not to mention, is it tax free? When you spend the money, does it continue earning interest for you? Nope. Would it blossom into a massive death benefit, income tax-free death benefit to your family if something were to happen to you? Nope. So there's so many advantages of the dividend-paying whole life insurance policy, which earns interest. You get guaranteed interest plus dividends, which these, dividends aren't guaranteed, but these companies have never missed a dividend payment before. So the policy earns interest too. When you use the money to pay cash for a car, what infinite banking calls borrowing from yourself, you borrow from the life insurance company, guys. You don't borrow from yourself. Your cash value is the equity, just like equity in a home, right? You pay the sinking fund back with interest. Okay, that's okay. So that's true. Where when you're paying the loan back, basically we're putting that money back into the policy. Okay, and there is an interest cost to it. The difference is that money shows up in cash value again, ready to be used, and it did not interrupt the compound growth process. When you do this with a sinking fund, that account is depleted. It's no longer earning interest. Sure, you can put it back, but you're restarting the process all over again. You lost all that interest growth when you depleted the account. That is how you keep. Let's see. You pay the sinking fund back with interest. That is how you keep up with inflation. I don't like that. I'm like, again, like, what do checking and savings accounts historically pay? So I don't know. It's just not as efficient. The sinking fund is always growing via interest. No, it's not. From the savings account or from your car payments to your vehicle sinking fund. It's just not efficient. It's so how do you say? What am I trying to say here? So much less efficient doing it with a savings account than with a dividend paying whole life insurance policy. It's just, the policy is so much more efficient. It also happens to be what infinite banking conveniently forgets for the sinking fund, and has excellent recall when applied to their life insurance product. But again, you're not telling the whole story here, man. Like when you deplete the savings account, yeah, you could save again, put money back in. What happened to all the interest that you were earning on the savings account when you deplete that fund? You're not. It's gone. When you use the policy, it's still growing uninterrupted. So I'm not going to beat a dead horse with that. What is that old saying? Figures don't lie, but liars figure. So he's calling Chris a liar. That's bold. He's just explaining the strategy. Well, I'm not calling. Okay, I retract my statement. Well, I'm not calling anyone a liar. I am calling the math into question. However, okay, I retract my previous statement. My apologies. Sometimes, I'm not perfect. I jump ahead sometimes. Okay. All right. In the video, we hear our first excited brag. See the $22,097 highlighted. Let's see right here. So he's talking about the increase in net cash value. Okay. That we are told is the increase in our cash value in year 2. That's correct. But let's dig a bit deeper here. The real brag should be that you contributed $220,000 to the infinite banking policy and still only have a cash value of $207,000. A loss of $12,200 up to this point. But okay, let's address that first. So let's see. Yeah, he dumped in $200,000. This is very similar to what I did with my first policy. I dumped in $120,000 in the first year. I'm doing $25,000 per year afterwards, and I have access to about $105,000 in the first year. That's really good for a whole life insurance policy, guys. That's like, I don't know, 85, 90% cash value in the first year, within the first 30 days. And I was able to use it to purchase my vehicle. That is really good. But see, the way he's talking about it is just kind of misleading, because he's only talking about it like it's as if we just moved our money to a different account, got absolutely no benefit from it, and we just lost money. Like if you were to move money from a checking account to a savings account, and all of a sudden you have a loss of $12,000, like you didn't gain any benefit from it. That's kind of how, like when I read that, that's what I hear. But guys, you're buying a life insurance policy here. So you're buying all of these massive benefits, and this is not a bad thing, because again, we're purchasing a benefit here, okay? But also we're kind of we're starting our own private banking enterprise. That's the way I look at it. Like every policy I set up now is like I'm adding another branch to my private banking system. Well, what happens when you start a business, when you start some kind of enterprise, when you open new branches? There's costs associated with starting that business. That's how I treat this anyways. So yeah, you're going to be behind for the first few years. Heck, most businesses aren't profitable, don't see a profit for years. But there's plenty of people that start businesses. There's plenty of people that do real estate. Oftentimes you're way behind in real estate before you start seeing a profit. Until you sell the property, or, until you've earned enough rental income to make up for the down payment, whatever, right? Like, so yeah, you're going to be behind in the very beginning, but it's because you're putting money into this really powerful system. You're starting this private banking system. So of course there's going to be a cost associated, but it's not like you didn't get anything for the loss of $12,000. No, we purchased a life insurance policy. The $22,097 highlighted in the video comes from the non-guaranteed columns. The guaranteed amount is less. That's true. The non-guaranteed column here is dividends. It represents the policy growth with dividends. That's assuming that dividends will continue to be paid. They're not guaranteed, but like one of the companies I work with, guys, the company I bought my first policy from, they have never missed a dividend payment since inception. 119 years they have paid dividends. My second policy, they paid dividends for 146 years. That's pretty good. I'm pretty confident they're going to continue paying dividends because they're so good at what they do. They're so good at risk management. All right, so there's that part. Yeah, the guaranteed column doesn't ever look really good in a policy. It's still like, it's like more the worst case scenario. It's still a good savings vehicle in my opinion. But yeah, the guaranteed column definitely takes a lot longer, but that's assuming that the company never pays a dividend ever again. That is extremely unlikely to happen, but I suppose anything can happen. All right. You still have a loss. It's not a loss. You purchased a benefit. You purchased a product. You're getting massive benefits for your money. You still have a loss regardless of what column of the projection you use. It's funny to me when financial advisors say this. Like, what would they say if you're a brand new investor, right? And you're putting your first deposit into an account for, that's going to be put into the stock market. And then 30 days later, just bad timing, the market goes down 10%. Now you have a loss of 10%. Like they just, I'm pretty sure they would just tell you, well, that's how the market works. And, it's ups and downs. We're in this for the long run. Well, we're in these policies for the long run too. And we're thinking about the long-term vision and goal of what we're trying to accomplish here. Of course, you can borrow some of your own money if you want, which we can. And so I mean, if you really have a problem with this loss, then you have the skills to build wealth, and maybe you're a real estate investor, maybe you're a really good stock trader, whatever. Go make the 12,000 really quick. Well, not really quick, but you know what I'm saying. I mean, that's what I'm doing with my policy. I'm making more money with my policy, so it can be very effective. Let's see. I guess one other thing I didn't. Well, he might point this out in a minute, but in case he doesn't, I do want to address this. The increase in net cash value, guys. So you're putting in 20,000, and the cash value is growing by 22,000, and it's just going to get better and better and better every single year over time. So if I were to tell you that down the street there's an ATM that when you put $100 in, you get $110 back. How long would you stand in front of that ATM and just keep putting a $100 bill in to get 110 back? And then the next year you come back to it, same thing, you put 100 in, but now it's giving you 120 back. Like, how many times would you do that? That's what's happening with these policies over time, is they get really, really efficient, and your cash value grows by a lot more than what you actually put into it. So let's see. Infinite banking's rate of return sucks. We don't set these policies up for rate of return, guys. This is not a good argument against infinite banking. These policies are very efficient savings vehicles. We're going to get that uninterrupted tax-free compound growth at 3 to 5% plus all the other benefits. That's a really good savings vehicle. And we're able to access the money to build wealth like we were going to anyways, or if there's an emergency. So that doesn't make any sense to me. Let me turn to longer term rate. Yeah. Okay. Before we reveal the true long-term rate of return in this whole life policy projection, we're not setting it up for rate of return. Projection of a promoter of infinite banking. Let's ponder the idea of tying so much money up in what the video is described as a savings account. It is. It's not an account. It's life insurance, but it's a very efficient savings vehicle. The whole, pun intended, premise of infinite banking is to have an ever-growing pile of money in a low-yield savings account. The only way to turn this into a win is to use faulty math. Well, I can't wait for this. But first, let's review the future value calculator. There's something I want to say here about this really quick. And actually, I'm going to wrap up here, and we'll do a part 2 going through more of this article. But when it's really interesting to me when advisors, I don't know if he's or accountants, whatever, when they're trying to make the argument that whole life insurance has terrible rates of return, so you'd be better off, instead of putting the money into the policy, because you can get a higher rate of return in the market, you shouldn't buy whole life. You should buy term and invest the difference. But what I ask advisors and accountants or whoever when they say that is, are you telling people to not save money? Because if you believe that saving money is important, then basically you would tell them, okay, you're going to buy term, invest the difference, and then you're going to have 6 months of savings over here in this other savings account. You still want to save money, and then you're going to put some money in the market. You're going to have term insurance. Okay, great. But here's the problem with that logic is you just said that because whole life insurance has a terrible rate of return, they should put their money in the market. Well, savings accounts have terrible rates of return, far worse than dividend-paying whole life insurance. So why would you tell them to put money into a savings account? Because savings accounts get terrible rates of return. So why not put all of their money into the market? Because that's where they're going to get the highest rate of return, right? Like, is that really the only thing that we're comparing and talking about here is rate of, and basing financial decisions on is rate of return? What about the external rate of return that we get from these policies? All of the things that we're able to do, not to mention, I feel a lot safer having my money with these mutually owned life insurance companies than the banks. I don't trust banks. I don't trust Wall Street. I don't trust government, nothing. I do trust these mutually owned life insurance companies, though. So, like, what's the rate of return on that? What's the rate of return on the piece of heavy equipment that I flipped that I made a profit on while my money was still getting uninterrupted compound growth? Like, what's the rate of return on knowing that my loved ones would be cared for if financially and taken care of financially if something were to happen to me? What's the rate of return on that? Like, there's so many other benefits to whole life insurance that you can't put like an exact dollar amount or percentage figure of rate of return, but it's absolutely there. Like, these things are just incredibly powerful. Just dropped my headphones. But anyways, I'm gonna go ahead and pause there, guys. I hope that was helpful. I will when I have part 2, I will drop that down in the description. I definitely recommend you check it out, because I mean, there's some really good talking points in here. And look, I don't mind. I actually like when people disagree and push back on things like infinite banking. I certainly did in the beginning as well. And I think these are really productive conversations for people to help come to a decision, an informed decision on whether or not these different financial products make sense, whatever that product is. I don't care. It doesn't have to be whole life insurance and implementing infinite banking. It could be buy term and invest a difference, 401ks, IRAs, real estate, all that stuff. But I think seeing both sides of the argument, that's what really allowed me to make an informed decision. And I got to the point where infinite banking was a no-brainer. Dividend paying whole life insurance was a no-brainer. And it's because I heard both sides of the argument. So I think this is really productive. We just, I want to make sure that we're also telling all sides of the story here. And he's unfortunately not really doing that in the article. But anyways, whatever. If you guys have questions, please drop some comments down below. I would love to hear your feedback, even if we disagree. That's totally fine. And if you want to have a conversation about maybe setting up a policy for you to start implementing the infinite banking concept, I'm more than happy to have that discussion with you just to see if it's a good fit. I will have a link to my calendar down below. Okay. I hope you guys are crushing it, and I will talk to you in part 2. Take care.